Hey guys, AQN or Algonquin Power and Utilities Corp has been one of the most talked about Canadian utility stocks on YouTube or wherever you look. It has been a rock star since the financial crisis. But now, is it in crisis? Q3 earnings in November were abysmal. There was this massive sell-off of 19% on the day of the release, followed by another 14% the day after. It is now down 46% year to date. The dividend yield is up to almost 10%, and everyone wants to know, what should I do? If you own it, should you sell it and take your losses? If you don't own it, should you buy in with the massive potential upside? I read through the earnings report as well as the MD&A, Management Discussion and Analysis, right when it was released. In this video, I'll be sharing some of my thoughts. Let's do this! This is what I personally think about my position with AQN. Remember, these are my thoughts and decisions based on my family's personal finances and goals. If you're watching this for more than entertainment purposes, please do your own research and make a decision in light of your personal situation, not mine. We all want to do what is best given our circumstances, goals, and outlook. And let's not forget, my thoughts and opinions are not always right, so take them with a grain or two of salt. And as a side note, AQN is one of the most talked about stocks on Blossom Social. It's a great place for Canadian investors to share thoughts and insights on investing, and it is completely free to download. Now, before I jump into the report, for those that don't know much about Algonquin, here's the Coles notes. Algonquin Power and Utilities can be organized into two divisions, the Regulated Services Group and the Renewable Energy Group. The Regulated Group has 83% of revenue coming from the US. The Renewable Group has 73% of revenue coming from the US. So it's pretty clear that this is mainly a US operation at present. So now with that background, here are the highlights from the report. Adjusted EBITDA of $276 million, an increase of 10% compared to the third quarter of 2021. That's really good. Adjusted net earnings of $74 million, a decrease of 25% compared to the third quarter of 2021. So that's really bad. Now here's the reason though. Higher interest rate expense of $23 million as a result of borrowing to support growth and higher interest rates, and lower year-over-year recognition of investment tax credits and production tax credits of $17 million. Also, adjusted net earnings per common share of 11 cents, a decrease of 27% compared to the third quarter of 2021. Now that's bad. And part of the reason for that is another negative. 64 million shares were issued over the past year, a dilution of 10%. Let's go to the flip side. The pending acquisition of Kentucky Power Company was amended, reducing the purchase price by $200 million. The reason why, though, we were not told. So that turns this kind of neutral in my eyes. Also, the inaugural asset recycling transaction took place, offloading some assets for about $400 million. That's a positive. And lastly, management updated 2022 adjusted net earnings per common share estimate. This is what they said, and I quote, "In light of challenging macroeconomic conditions, including higher interest rates and inflation, delays in the construction and completion of certain renewable energy projects, and anticipated delays in connection with certain rate decisions, among other factors, the company is updating its previously disclosed adjusted net earnings per common share estimate for the 2022 fiscal year from a range of 72 to 77 cents to a range of 66 to 69 cents. Now that's a massive decrease. In the report, management identified a bunch of risks and uncertainties for the business. The biggest one being, as of September 30th, 2022, the company had approximately $7,705 million in long-term debt. Management mentioned fluctuations in interest rates, including the rate increases experienced to date in 2022, could materially increase the corporation's financing costs, limit the corporation's options for financing, and adversely affect its results of operations, cash flows, key credit metrics, borrowing capacity, and the ability to implement its business strategy. As of September 30th, 2022, approximately 78% of debt outstanding in AQN and its subsidiaries was subject to a fixed rate of interest, and as a result, such debt isn't subject to significant interest rate risk in the short to medium time horizon. Well, that means 22% is variable and has increased 250% in such a short order. Now that's very, very bad. And lastly, inflation risk. Algonquin's profitability could be impacted if inflation increases above long-term averages. The Regulated Services Group's facilities are subject to rate setting by its regulatory agencies. The time between the incurrence of costs and the granting of the rates to recover those costs by regulatory agencies is known as regulatory lag. As a result of regulatory lag, inflationary effects and timing delays may impact the ability to recover expenses and/or capital costs, and profitability could be impacted. So after all this negative news and the stock tanking 32%, the CEO released a nice little letter to shareholders saying he and other board members are purchasing shares. The CEO bought 1.1 million worth at $12.30 a share. I consider this a good move, though it can be interpreted as desperate to calm the market. Most analysts have downgraded Algonquin with the hold or sector perform rating. They also see no dividend increase through 2024, with the payout ratio dropping to only 97% by then. So after all of that nonsense, what are we going to do? As a small position in our portfolio, I believe in the long-term ability of Algonquin to run a stable, cash-flowing business. I think they can turn the ship around like they did after the last financial crisis, only to bring massive cash flow and returns to us. So I believe this current situation gives us an opportunity to increase our position size at a major discount on future earnings. Right now, it's not going to be pretty, and if variable rates increase another 2%, they will have major cash flow issues. The solution would be twofold in my opinion. A reduction of the dividend, which would save them $210 million a year with a reduction of 33%. Also, they would have to offload assets in the renewable space that have long-term energy contracts at a loss. And I would be okay with that scenario given our 20 to 30 year investment time horizon. And that is why we purchased 15 shares at an average price of $12.44. If you missed my portfolio update where I reviewed all 16 of our holdings, you can check it out here. Thank you so much for watching and helping the channel out by smashing that like and subscribe button. Until next time, I'm Mr. Financial.